Good evening, everyone. I welcome all of you to the virtual CPE meeting on commodities market overview and energy price risk management. Today's session will be divided into two sessions. The first session will be taken by CA Ruchi Shukla ji, and the second session will be taken by CA Gauri Methi. To begin with, let me introduce you to the chairman of J&K branch of NIRC of ICAI, CA Nakul Saraf, to say a few words and welcome each one of you.
Good afternoon, everybody. I welcome you all to today's webinar on behalf of the J&K branch. My name is Nakul Saraf. Today we have a webinar on MCX, and the expert faculties are very well versed with the topics. And about MCX, I will share a little bit of the knowledge which I have got. The Multi-Commodity Exchange of India, that is MCX, India's first listed exchange, is a state-of-the-art commodity derivatives exchange that facilitates online trading of commodity derivatives transactions, thereby providing a platform for price discovery and risk management. The exchange, which started operations in November 2003, operates with the regulatory framework of Securities and Exchange Board of India, that is SEBI. MCX offers trading in commodity derivative contracts across varied segments, including bullion, industry metals, energy, and agriculture commodities, as also on indices constituted from these contracts. It is India's first exchange to offer commodity operations options contracts, bullion index futures, and base metals index futures contracts. The exchange focuses on providing commodity value chain participants with neutral, secure, and transparent trade mechanisms, and formulates quality parameters and trade regulations in conformity with the regulatory framework. The exchange has an extensive nation reach with 597 registered members and 49,999 authorized persons, with its presence in around 1,103 cities and towns across India as on 31st December 2021. MCX is India's leading commodity derivative exchange with a market share of 92.9% in terms of value of commodity futures contracts traded in financial year 2021-22, April to December. The exchange flagship index series MCX ICOMDEX is a series of real-time commodity future price indices which give market movements in key commodities segments traded on MCX. The MCX series, this series consists of a composite index apart from three sectoral indices: the base metal index, the bullion index, and the energy index, and also 9 single commodities, that is gold, silver, aluminium, copper, lead, nickel, zinc, crude oil, and natural gas. Now, apart from this, there are many more information about MCX that I would like the speakers to please share with the members. Now I request Ayushi to please introduce our first faculty member for the first session. Thank you.
Thank you so much, Nakulji, our chairman. Very good evening to everyone. This is C. Ayush Sahani. I am treasurer and executive committee member of J&K branch of NIRC of ICAI. I would like to introduce CA Ruchi Shukla ji, Head of Energy, MCX India Limited, in today's webinar. Welcome, ma'am. Ma'am is an experienced fellow chartered accountant, DISA course qualified, and has over 18 years of experience in financial market across functions, policy research, product management, risk management, compliance, business process, with a range of organizations including regulators, stock exchange, banks. She has also done securities and market law and advanced business analytics from IIM Ahmedabad. She was also appointed as expert consultant by Forward Market Commission, Government of India. Presently, she is spearheading the energy products and strategic initiatives at MCX. Ma'am, we are very privileged to have you amongst us today, and please share some light and please appraise us with the information on the very hot topic we are having right now. Over to you, ma'am.
Thank you so much. First of all, the JNK branch of NIRC. Thank you so much, CA Ayush Sahani ji, CA Nakul Saraf ji, CA Priya. Am I audible clearly? Yeah, CA Priya. It's a privilege to be part of this. First time actually I'm coming as a speaker for the JNK branch. It's a privilege to be amongst you all. So today, as I just plan to cover commodity derivatives, we all know what equity markets are, equity derivatives are. But yes, today I'm going to cover commodity derivatives. And in that, how energy recently with the Russia-Ukraine war, I know everybody is aware how the crude oil prices have gone to around $125 and everything. So we'll discuss. That's a hot topic. As CIOG really pointed out, the hot topic today is that. So I'll throw some light, whatever experience I have on that basis, I'll just throw a light on that. Yeah. So just to give you an overview of the first, as we are representing my exchange, the first disclaimer is I am not making any kind of an advisory or a consultation for any investment or trading in commodities. Today's session is just a basic awareness session. So what are the commodity markets? Every part of our life has some or the other commodity involved. We go to physical market, we purchase that market. That is nothing but a spot market. So we may go to a retailer, but yes, there are APMC markets and all. So that's a spot market. You go to the jewelry, Zaveri Bazaar in Mumbai, say. So that's a spot market for the commodity gold. Then on physical side, then we have the forwards, like one-to-one contract, which people enter into to buy a certain product at a certain date. But these are non-standardized. One-to-one bilateral contract happens. These do not provide you any credit guarantee or something. So this entire spot plus forwards together forms the physical markets where you take the actual delivery of the product. Then we have the financial markets, the derivative markets. In Indian markets, on the financial leg, under derivatives, there are two kinds of products allowed, futures and options. The same goes for the equity markets and same for the commodity markets as well. So as I go down the line, I will just first come to that slide. So this is a structure, the regulatory overview. So SEBI, as I just said earlier, it was FMC, the Forward Market Commission, who was handling the commodity derivatives market. But in 2015, SEBI took over as a regulator. So SEBI is now at the jurisdiction and under which the stock exchanges operate. Today, be it NSE, BSE or MCX, they are at par the stock exchanges. Though as MCX, we focus on commodity derivatives and NSE, BSE is focus on equity markets. But we are allowed to launch equity, they are allowed to launch commodity, and they have also launched commodities. Then under stock exchanges, we get the members. Like the national brokers, you may be aware of, I'll take the common names just as that because you may be aware of what Zerodha is, India Infoline, Motilal Oswal, Angel Broking. These are the brokers under which, like if you're purchasing on equity market, you enroll as a client and then you go to the market or place an order for the purchase of any kind of shares. So same happens under members, we have clients. So each one of you is, actually this market is also open, commodity derivative markets totally. Each one of you is also allowed to trade in this market. So there is no restriction per se. In fact, after SEBI came in, there were a lot of new products developed, new commodities allowed for trading. And on the more, to that extent, new participants, like today, even mutual funds, the AIFs, and next in line will be FPIs who will be allowed to participate in these markets. MCX overview, Nakulji has already given an overview. I'll just give you a highlight of today. MCX is holding 90% market share in the commodity derivative space. The other derivatives exchange is NCDX, which focuses only on agri products. So we focus on metals and bullion and energy, and their focus is on agri products. So as you can see, there are 4 different segments. Under precious metals, we have gold and silver. Energy, we have crude oil and natural gas as our product. Base metals, we have all the industrial products like aluminium, coppers, nickel, zinc. Agri products, we have a very little market share because we trade only very few agri products. And then we have the indices and futures on those indices. Now, at an average, if you see an average daily turnover, sometime, 2021, we also took a hit because of COVID. But now we are again back into practice, and our average daily turnover is 30,000 plus, like 31,000 crores. This is a single side turnover, which we are witnessing on a platform, which indicates how liquid our platform is, and liquidity and more participation definitely brings in the efficiency of the platform. So we have 597 members with 51 lakh terminals spread across 1,200 cities. And if you see the UCC is a retail client participating, so 86 lakhs. So that's a kind of depth. But yes, if we compare the global markets, we are still far off, because if you see global markets in commodities are multiple times of equity. Wherein in Indian markets, we are still at a very nascent stage if we take into account the commodity derivative space. Now, under SEBI, the process is SEBI notifies the commodities on which the trading is permitted. So till date, SEBI has notified 91 commodities where exchanges are open to launch derivative contracts, out of which only around 19 products are yet till now trading, and others have not opened up yet as of now. So with this overview of commodities, today's our focus will be on energy sector. So I'll highlight we'll talk of what are the fundamentals basically, what are the crude and natural gas both, and then I'll move on to risk management, because I guess like today's audience most of them will be CAs or maybe about to become CAs. So risk management is a space which is open for the chartered accountants. Just last week, I was at ICI Bhavan, Delhi. So I had a meeting. So there were discussions on what are the new spaces. Now, this is a very open space, risk management, because if I really consider Big Four, there are small SMEs, MSMEs in our countries. Now, everybody cannot approach Big Four for a risk consultant or to hedge a product, but they are exposed to the risk, and who best? The chartered accountants are the best people to be able to advise them. So it's a huge open space, huge opportunity for especially the practicing chartered accountants. So crude oil fundamentals, now crude oil in Indian markets, a larger proportion, in fact, most of the proportion, we import crude oil. So naturally, the prices in crude oil are largely impacted by global prices and global fundamentals. Now, IEA, just one second. Yes. So IEA is an international body which comes out with the demand supply global factors. So if you see the world oil supply and demand, the green color line is indicating your demand, whereas the black line is providing you the supply. So 2020, yes, the COVID era, you can literally see the demand falling steeply, a steep fall in the demand. And then once, the market started, the country started opening up with the vaccinations happening, the lockdowns, restrictions moving out, the demand picked up. Yeah, but yes, the supply still takes some time to cover up that demand, because demand immediately went up, especially with the logistics opening up, the international national travels opening up, and the demand being high and the supply. Recently, OPEC bodies have decided to pump in or increase the supply in the markets. But with this, the war situation happening, we really don't know what the situation is going to be post March or April. This is an overview of the global supply and consumption. If you OPEC and non-OPEC bodies, so a larger proportion of the production is coming from non-OPEC production, and then we have the OPEC production and consumption by the other, because there are exporting countries and on the other one like more are importing countries. But more so this, you can see the kind of a growth which has fallen behind in 2020 and picked up in 21 and 22. It is again on a larger pattern of growth. If anyone is wanting to track crude oil markets, I'm sure you may have certain clients who are exposed to crude oil or any kind of a byproduct also. Suppose I say you have some clients who are in the glass industry, so they will have exposure to natural gas is a larger component of their raw material cost. Otherwise, if you see, there may be paint industry, again, they have indirect product, they have that turpentine oil, they have a indirect exposure to that. I will take fertilizer industry, yes, they are exposed. The steel industry, again, either directly they use in the furnaces or anything, or they may have the other kind of byproducts may be linked up like naphtha, bitumen, or the polymer. So, and petrol, diesel, anyways, we all are linked to petrol, diesel, we have an impact on that. So these are the certain factors which actually affect how the crude oil prices move in the global markets and accordingly in the Indian markets as well. First and foremost, yes, the OPEC announcements. OPEC is a body which generally controls the consumption side of the supply side. So any OPEC announcement during the COVID period, OPEC announcements which brought down the product supply due to so that the prices can stabilize. Otherwise, with the demand falling back so much, if the supply was not reduced, then the prices would have gone haywire. So OPEC announcements is one thing. They regularly conduct the meetings. So that's one thing. Then global demand and supply comes generally, the demand leg comes from how the GDP or the markets are growing, but the supply scenarios are coming from the oil producing countries. Then the currency exchange rate and inflation, if I see, yes, US, the impact of the US dollar, the appreciation, depreciation, and in Indian context, the appreciation, depreciation of Indian rupee towards the US dollars has an impact on the oil prices ultimately. First of all, we go to the geopolitical events. The recent example, a great example, Russia invading Ukraine. We have seen the dollar war, the crude oil was lying around $80 to $85, and it within 2 weeks it grew to $125. Now gradually it is back because one is China market is witnessing with Shanghai, Shenzhen, and other cities going in a lockdown, the expected reduction in the demand side of the product, and then they were also, the supply has also been affected on the left. So because of that, it has come down. It's settling around now. Today the crude is around $96 as per Indian markets. So that's a kind of an impact a geopolitical event can have. Then the government trade policies. Yes, if I say the sanctions being lifted, there are Russia-Ukraine war only sees, so we see how the US government has put out sanctions on the Russian. Then we have sanctions on Iran. That's the market is waiting. When if we have a lift out on the sanctions on Iran, there may be another supply coming into the market. So these government and then US-China trade policies have always impacted the oil prices as well. Weather variable is more so linked, lesser to crude, but yes, more to natural gas. But crude in the sense we have, but if US markets have the summer driving season, and then, but natural gas in the winters, if we see the winters, the natural gas goes because they have a lot of requirement for the heating purposes. Then yes, the US crude and inventories. So this is a report which comes every Wednesday. In fact, the market participants who frequently trade on these contracts, they track this report. This comes around, I think, 7:30 p.m. Indian Standard Time in the evening. This EIA report comes on the US crude inventory. So if the inventory is reduced or the inventory has increased on week basis or month on month or year on basis, that impacts the ultimate prices of the crude. US rig counts, yes, that all report also comes on the weekly basis, which again indicates rig count means rigs is the place where the crude is being refined actually. So if there is an increase in the rig count, that means the supply is going to be increased, because that means more of a refining process is taking place. Then you have the global economic, which is a fundamental. Economic fundamentals, yes. Global growth, global demand increasing. Once the demand is there, the consumption is there. Definitely, the exporting countries will push in the supply as well. But yes, they have certain capacity constraints as well. So that is why we are expecting Saudi Arabia and India, especially if the Iran supply comes into the global markets, that is going to impact. It's going to have an impact on the prices as well. So these are the factors on overall basis which the markets can track, and in fact the chartered accountants can also track for their clients. This is just a collation how during every month how the prices have moved. So if you see, yes, Russia attacked Ukraine, US President Biden responded to the wave of sanctions. Inventory, Jan 2022, Goldman Sachs actually reported that they expected that the oil inventories are going to fall to their lowest level since 2000. So because of this, the crude oil prices had shot up in Jan. So again, the impact of the inventory levels. December 2021, it was an announcement from the OPEC and OPEC Plus group. So these are the this is just a collation of the factors, and these are the real events which you can link up to those factors. If we see how the market prices, this is in rupees per barrel. So if you see, yes, prices somewhere around under 5,000, and here we are seeing prices around over 9,000. This was the time of that $125, which was be converted at RBI reference rate to come out with the prices which trade on the MCX platform. So that's a kind of a movement which has taken place because of different events happening now and then, and the latest is obviously the Russian invasion of Ukraine. If we collate all these factors, so the prices will push up on the band, on the barrel, the prices get pushed up if there's the normal economics, greater crude oil demand, weaker US dollar, OPEC reduces the production, there are supply disruptions happening, which happened in 2020. In fact, the storages were full and the WTI hit the negative zone. Downward price pressure, global increase in production, build up in the inventory. OPEC increases the production, or global pandemic, yes, we saw huge pressure because the demand was at the lowest. So on the balancing beam, if the prices is to be, these are the certain factors which is going to take the prices up, and these are the certain factors which are going to push the prices. Moving on to natural gas fundamentals. Just to give you an overview, natural gas, though a fossil fuel, but it is considered to be a greener fuel. Currently in an Indian energy mix, we are standing at 6% usage, and a government aims to have at least 15% usage by 2030. Especially because, yes, we are part of the COP25 and we also want to reduce the emissions levels. That's a need where natural gas push is happening in Indian markets. So if we see at the global level energy demand, gas demand is growing at a higher rate than all other, especially the oil and coal, because the developed countries especially are reducing their thermal generation, whereas India, though we have around 70% thermal generation, but we are pushing towards renewables as well as the more use of natural gas in the region. This is Indian domestic gas production and LNG imports. If you see, domestic production is on the reducing trend, because this is, I will not go into detail, but this is because of the pricing mechanism generally. So, and this requires a huge infrastructure outlay also, huge investment has to go, and there's a gestation period when your plant will actually start running. So it's on the reducing trend, but our consumption is going to increase. So obviously, what we will get it from imports. LNG imports have an increasing trend. So these are the basic factors affecting crude oil and natural gas. More so, all the other factors remaining the same. What happens is the weather conditions has a huge impact on the natural gas, because European and US regions witness a huge demand for natural gas in winters because of the heating purposes. So generally it's observed the natural gas prices go up, rise in the winter season, and this March the lean period almost starts up, because towards March end their heating demand gets reduced. Then we have the natural gas inventory data again. This data comes on every Thursday. This data is released, and the US rig counts, the crude and natural gas both rig counts data is given by Baker Hughes. It comes on Friday around at 7:38 p.m. IST time. It's released online. It is available online. So actually, this is the report which the markets also track. And then we have the industrial and residential demand. But yes, another big factor is availability and the prices of alternate fuels. Now, for natural gas, the major cheaper alternative fuel is coal. So, but coal, on the other hand, increases the pollution levels. So there's a balance which is getting created, though developed countries have tried and reduced a lot of their exposure to coal markets. But yeah, developing countries like us or Indonesian markets or Asian or South African markets, they will survive because we need coal. We cannot use a very expensive mode like natural gas is at the highest levels right now. Again, so hydro and renewables energy, yes, renewables energy a push is happening, hydro energy a push is happening, but that takes time ultimately to come into light. And the need of our market, need of Indian market, the kind of population demand we have, we really have depend on coal. But yes, we have a greater push is happening on the natural gas. So herein are the, from March 21 till date, if you see the prices, it is in rupees per MMBTU. That is the unit for natural gas in which it is traded on our platform. So it's around 175 rupees per MMBTU. And we have seen the highs of around, this is 475 around per MMBTU. That's a kind of a rise which has been observed in natural gas as well. And the latest impact has been of the invasion factor only, the Russian. What happened was the Europe, the larger supply comes from Russia. For the gas, the larger supply comes from. So there is Nord Stream 1, Nord Stream 2. Nord Stream 2 was in the commissioning state. Nord Stream 1, the pipeline, it comes from Russia to Germany via Ukraine. So that supplies got disrupted. Nord Stream 2, Germany announced that it is not going to commission Nord Stream 2 because of Russia's invasion of Ukraine. So the huge supply has been affected. And in fact, from the US, now the gas supply to the European and through the Europe to the Asian markets is increasing. In India, we get a larger component of the gas from Qatar, Australia, as well as Henry Hub means the US markets. The larger components are from Qatar and Australia, but recently with the GAIL entering in a big contract with the Henry Hub, a larger component will also come from the US. If we see the balancing beam, yes, the prices where NG gets pushed is demand and the weaker US dollar. Where they get pushed down is, okay, the average storage is greater than previous year. So that means your buildup is happening, demand is reduced. Obviously, the price pressure is there. Abundant supply, declining US natural gas imports, or favorable weather conditions. Favorable means less of, if the winters are not so harsh. So that means a favorable condition and the demand will be less. Now let's run through. Now we have understood fundamentally what these two products are, what these basic commodity derivative markets are. So we move on to what are the kind of products that are available if you want to trade. Now on MCX platform, we have futures and options, both for crude oil and natural gas. Our natural gas options were recently introduced on 17th January. If I run you through the contract, the futures contract of crude oil, now 1 unit is equivalent to 100 barrels. And the underlying for my product is the WTI NYMEX. So the Crude oil, WTI, which trades on the NYMEX group, we have entered into a licensing agreement with CME Group. That is the underlying for our product. Now we have understood the fundamentally what these two products. So the price quotation is in rupees per barrel. Tick size 1, price movement, hence say tick size is 1 rupee. So 1 unit is 100 barrels. So 1 into 100. So price movement per tick which is happening on your 1 unit, if you have purchased 1 lot of it, it will be 100 rupees. Now, initial margining mechanism is the risk management mechanism adopted across the world for derivative markets, accordingly on our platform also. So as per SEBI guidelines, depending on the kind of volatile the product is, it defines the minimum levels or the span. So for crude and natural gas both, we have minimum 10% or span whichever is higher. Now currently, we see the volatility happening. So our crude oil contract margins, this margin which could be minimum 10%, it has risen to around 26 to 20. It is varying between daily since last 1 week between 26 to 28% of the margin. And considering the current size of the current price happening and the 100 barrels, so the current contract value happens to be around 7,30,000. Now the natural gas we have, and sorry, the settlement. Finally, the settlement, see, as I told you, this derivatives has to actually converge with the spot. So at the end of the contract, since the underlying of my product is WTI and IMEX, the DDR, the due date rate or the final settlement price is calculated basis the NYMEX on the last day of the trade. The dollars is multiplied by the RBI reference rate and we derive the rupees conversion. So when you trade on these products, you do not have a forex exposure or the forex risk, because these two products naturally absorb the risk because of every conversion is happening at the RBI rates. So you do not have like if you are trading in this, you don't have to go and hedge your forex risk as well. It is an inbuilt natural taker of the forex risk. Natural gas, our 1 unit is 1250 MMBTU. The price quotation is in rupees per MMBTU. Tick size, smaller tick size, 10 paisa, because the value is less, 300 to 400 per MMBTU. Initial margin 10% or span, whichever is higher. And contract value, at the current price, it is coming around to 4,37,500. Now this 10%, because of the volatility, it has gone currently at around 18%. Final settlement, again, we have a tie-up with the CME Group licensing agreement, and it's a Henry Hub contract. So US Henry Hub contract is underlying, and so due date rate is based on the NYMEX close price on the last day of the contract. For crude oil, we have 6 months contract, 6 months ahead contracts available. For natural gas, we have 3 months ahead contracts available for trading. Now, these two factors are the correlation, as I said, correlation with the derivatives and the spot. The underlying market is the indicator how efficient the market is, how well you determine the fair settlement price. So both our crude oil and natural gas underlyings are 98% and this is 96%. The difference being is only because of the difference of the forex rate, the USD INR rate. So that is the difference of this correlation not being 100%. Otherwise, they are completely in sync with the underlying prices. Now, this is just showing you the depth in the markets currently. So 1920 definitely was a very great year for our crude oil contracts, but 2021 with the COVID setting in, it took a huge hit, and more so in April 2020, the WTI went into negative. It went into negative around negative $40. So because of that, the turnover levels actually took a huge hit, but gradually, if we see 2021-22 is been a reasonably good year for us. Currently, it went around 4,000, and as the best part is the red is the options contract. Now, options contracts are considered to be very cost-effective contracts, and our markets have taken up well. These contracts have been considered well because these are very cost-effective, and now we see a huge volumes in option contracts. If I take, this is till YTD, year till date, but if I see the last quarter, we have done around average daily turnover of around 7,500 plus one side on options. So this is also indicative over here. If you see the Q3, the November, December, Jan, Feb has been a real performer with around 13,500. In fact, yesterday we did the highest. We again did an highest in options of 35,000 plus crores, 35,000 plus single side turnover. So that's a kind of a liquidity. If you see such kind of a, obviously there are a larger number of participants available. The market is accepting this product, and hence we see such kind of volumes available. Open interest is an indicator again, and another indicator, the efficiency of the contract. So if you see, we are almost going back to our pre-COVID levels. We are almost about to achieve our pre-COVID levels in the open interest, the open positions which are maintained on day basis and then rolled over to the next month. Natural gas has also again been a very good performer. So currently, this is in million MMBTUs. So currently, we have seen around 164 million MMBTUs of volumes available, and open interest again, it's around 17 million MMBTU. So now understanding, after the basic understanding of these products, we go to, this is the field which I was talking of. Yes, this is the field which is open for all the attendees who are attending today. Risk management, hedging. Now, risk from any market. Today, if suppose I'm standing here, the prices of our raw materials can go anywhere. So this is the scenario. This is what we need to hedge. Wherever the movement should be, our budgeted amounts, our budgeted cost of production, our budgeted cost of inventory, our profitability levels, our profit margin levels should not be hit wherever these prices move. So we need to hedge that risk. That is called a commodity prices we need to hedge. We all take insurance and we pay a premium for it. Insurance is another kind of a hedge for our future, but premium is a cost. So obviously this also has a cost, but it's also a need. Now, in any kind of a market, be it equity or this commodity derivatives, there are different participants. Now, one leg will be the hedgers, who are the risk averse people. And then on the other leg, we have financial investors who are the risk takers. Risk from the market is not going to go out. It remains, only that it transfers from one kind of participants to the other. Now on hedges, we have corporates, we have farmers, producers, consumers, all kind who are actually exposed because of their business. Then on the other leg, we have investors, arbitrators, speculators. Today we have mutual funds, PMSs, who actually take this risk out. They take this opportunity to make huge profits or huge losses, both ways it goes. But they are the risk takers. This slide is an interesting slide because till now, you must be exposed to a lot of clients who have, say, exposure, export, import, or certain, so exposure to forex risk. And every chartered accountant has till date in so many years ensured that if the company is exposed to the forex risk, they are going to hedge that risk somehow. That risk cannot be kept open, and this disclosure for listed companies comes in the annual report. Now, SEBI, our regulator, over the period realized not only the forex risk, all these companies are also exposed to commodity risk, commodity prices risk, their raw material cost risk, their finished product, their inventory cost risk. So this is the table which needs to be provided under the annual report under corporate governance section, wherein all the listed companies have to provide what kind of exposure they are having to the commodities, quantify it, whether they are keeping it open or it is hedged, and if it is hedged, whether they are hedging in domestic markets or international markets. Now, if a regulator is directing the listed companies to provide such a kind of a detailed report disclosure in their annual report, we can understand the importance of keeping this risk open. This is a huge information from the investor point of view also. Suppose I'm investing in a company. I'll take you to that example actually. So this is what I was talking of. If you see last 5 years, this is the risk. All chartered accountants ensure that their clients hedge this risk and they don't keep it open. But the maximum it has gone is 7%. And if you see the crude oil or the natural gas, on an average also, if you see, it's never gone between 35 to 40% risk is there, which is kept open because risk management in our corporates, it's still at a very, very nascent stage. So that's why, but yes, there's a push from the regulator. There's a need, rather than the push also, the companies are feeling, we are gradually, in my experience over these years, I've seen now companies are feeling the need to hedge this risk, because if they keep it open, that goes and directly hits their profitabilities and the profit margins. This is an example. These are true companies. Without taking the name, we have taken this data, analyzed it from their annual reports. They are in the same sector. They are exposed to same kind of a commodity. So same price risk. Now, PAT to operational ratio, company X is 6%, company Y is 1%. Growth in PAT, company X has shown 32% growth, company Y 2%. Share of material consumed, 92 and 99, and they're exposed to same kind of material. Huh? The only difference what we found was company X provided a proper disclosure of the commodities, and they indicated that they hedge this risk completely on the exchanges platform. They have hedged their risk to the exposure. Whereas company Y, they have not made any disclosure, which clearly indicates they have kept their risk open. They have not hedged this. They are exposed to same commodity. I cannot take the names of the companies or the commodity, but yes, they have taken this exposed to same, but see the kind of a profitability of the company, impact on their profitabilities. This is a live example, and actually this is very relevant to all the audience today. Okay, so now if you decide, yes, I have this client, they have to hedge. So what kind of a cycle of hedging, I'll just take an overview of it. First step is the management and our chartered accountants together need to decide what is the risk appetite of that company. Risk appetite is nothing but, if I'm exposed to say 100 rupees of risk, I am not going to hedge 100 rupees. There is a cost benefit analysis. So maybe I'd say I will hedge 40% of the risk, and certain 60%, there is something like 20-30% is my pass-through mechanism, other I can absorb. So risk appetite is how much risk you are ready to absorb in the and how much you are going to hedge. Based on that, you formulate a risk management strategy, which again has 4 different steps. First is you have to identify the exposure. To which commodity you are exposed to, the company is exposed to, how much is the exposure. Then you aggregate or consolidate. Consolidate basically means there may be vertically integrated companies. So if one of the subsidiaries is exposed to a raw material, that risk may be getting absorbed by the other company because it is again processing that raw material and passing on through the finished product. So the risk is, so you actually collectively, generally, hedging takes place at the group levels and not at a subsidiary. Generally, it is taken. In case there are correlated or vertically integrated, that's a consolidation stage, aggregating the risk. Once you aggregate, then obviously you know what kind of exposure you have to take. You undertake hedging transaction. Commodity derivatives platform is a better platform to hedge because there are standardized products. Counterparty guarantees provided by the exchange and the clearing corporations. You have zero credit risk. Your entry and exit is easy. You can enter and exit any time. Then finally, once you have done it, nothing happens without assessing what was your performance, whether you were able to achieve the objective completely or whether there was in lag. Some things need to be changed in your hedge policy for next year or something, that decisions. Finally, the entire governance process. So this is the risk operating, the entire model life cycle of which I'm sure we can take up with small size SME, MSMEs, big companies also, any company, but this is the cycle every company will need to adopt. Just one of the examples I'm taking, suppose a company had budgeted that, suppose they're exposed to a monthly consumption of crude oil, 10,000 barrels is their consumption monthly. Now, the budgeted cost at the time, say, I've just taken 1st December, okay, at the budgeted cost, so we are considering the spot market price at that time was 4,000. So they budgeted a cost of 4 crore rupees. Now, suppose this company had not hedged. So they have budgeted, okay, in December, my budgeted cost is going to be 4 crores at the price of 4,000 per barrel. Now, had they not hedged anything, the prices in December from on the spot market went from 3,800 to 4,100. Now, this company had not hedged. So this 4,000 has to be 3,800, 3,800 if we see 3,80,000. So they had not hedged. So they are going to face a loss of difference between these prices. Obviously, I am not taken anything. मैंने budget किया बॉस की आज मेरा spot में मैंने खरीद लिया पूरे month का consumption 3,800, but okay, because obviously you're not going to store it. You're going to keep on buying, keep on utilizing. The cycle goes on. At the end, 31st 4,100 गया. On an average, आपका जो भी आया है, तो you are facing a loss of, in your budgeted cost has gone up by 0.3 crores. Simple. Now, suppose this company had undertaken hedging because crude oil product is available for hedging on MCX platform. So, okay, what he does is he goes and locks in the crude oil futures price. Futures price at that time, there will always be a difference because there's spot plus cost of storage plus you have the opportunity cost of capital that brings to you the futures price. So there will be a upward move. So he locks in at 4,000. Again, 31st December, they close out the position, which again the prices was at 4,200. They make a 200 per barrel profit. They are in a profit of 0.20 crores or 20 lakh from this market. Ultimately, net to net, this company is negative 10 crores, negative 10.10 crores. So what actually I wanted to tell you is what hedging basically does is, I think we're running short. So what hedging, whenever the first concept which all the CFOs or CAs need to pass through to the managements of the companies is hedging should not be considered basically as a speculative transaction. Hedging per se is spot plus derivatives profit, ultimate impact of hedging. So either the आपको spot में you will gain something, you're going to have a profit in spot and loss in derivatives, but net to net आपका budgeted or profitability will remain the same. Or what is going to happen is आपका spot में you will have a loss and derivatives में you will have some profits. So net to net, your budget remains the same. It's a zero-sum game. Hedging basically is called as a zero-sum game. So you remain at either you're facing this kind of a bandwidth of losses. So what with hedging, you're coming at zero levels or bandwidth, you're reducing little profits or little loss. But you are not going to get huge losses or big impact on your profitabilities. That is the basic purpose of hedging. What we have seen in the markets is कि अगर derivatives में profit हुआ तो yes, boards and managements are happy कि profit हो गया बस ठीक है. But अगर any entity has a loss in the derivatives, say they will say तुमने सट्टा किया, तुमने ये speculative लिया. But what we need to propagate is you have to consider plus or minus what you're doing on spot. Hedging is not an independent thing. It is happening along, derivatives trading is happening with the spot. So these were, if we see this kind of an industries, like there is no industry, I think the big industries which are not exposed to some kind of a energy price risk. This can be furnace oil, diesel, gasoline, petrol, naphtha, ATF, anything. But they are all highly correlated to the product which is trading on the MCX platform, the MCX crude oil. Anywhere 85% plus correlation is considered to be a very good correlation to be able to hedge that indirectly. So all these products again can be hedged indirectly, or if you have a direct exposure to crude and NG, then they can definitely be directly hedged. Can you let me know how much more time I have on this?
You can continue, as I am definitely sure members are loving the deliberation.
Okay. Then I have no problem. Otherwise, I'm not making the speaker wait. Now, I'll just put throw a light on the options. Futures we have studied. Yes, futures options are considered to be if you are trading on equity derivatives, you will know options is considered to be a more cost effective product. So definitely it is also cost effective for hedging purposes. In fact, you can also create a combination of strategies of futures and options and be on the covered leg, which is again a very low capital intensive also and low transaction cost. So that is the reason why options is being preferred. And we earlier introduced the crude oil options. Now 17th Jan, we have introduced natural gas options, and they have also been picked up very well. We are witnessing around 1,500 crores of daily turnover in the natural gas option contracts as well. And as I said, counterparty risk anyways is not there even in the futures and also in the options, because our clearing corporation stands between the buyer and the seller. There's an anonymous trading happening. So there's a counterparty guarantee or the novation provided by the clearing corporation of MCX. If I run you through the contracts type, so these are the crude options, and we have seen the contract specifications of futures. These are for options. Crude oil option. Now the options which exist in our markets in crude oil and energy are the options on futures. So what is this? Which means is the crude oil options, the underlying is our MCX crude oil futures contract, which means at the end of the expiry, on the expiry day, if you keep your positions open and they are in the money, these are going to devolve into the crude oil futures contract. And expiry day of the options is 2 business days prior. So 2 business days prior, then they devolve. So you trade in the same futures contract for 2 days, then the futures contract settles. Or else, if you do not exercise or you close down your position prior, then it is a cash settled product. So futures, again, both the futures are cash settled, crude oil and NG, and these are the devolving products. Natural gas options, yes, again, our natural gas futures is the underlying. ICE quote is the same. We have actually, because of the volatility happening recently, we have increased the number of strikes. So never you will be out of the market to be able to trade into these kind of products. Overall benefits of trading on why to trade on MCX or hedge on MCX. One is, I told you, it's a standardized product, no counterparty risk. There is NG and crude are cash settled products. So there's no threat of your delivery. So you can purely manage your risk on this. No forex risk inbuilt. Naturally, the forex risk is taken care of. The timings, markets operate from 9 in the morning to 11:30 or 11:55 in the night. So that's a kind of a coverage we have. So you have exposure to global, the domestic requirement is fulfilled with the exposure to the timings of the global markets as well. And there are a lot of risk management measures, wherein one of them is the fixed daily price limits. So always we are concerned, ye sattabazi to nahi hai. No, this is not purely a sattabazi, because there are the risk management, the surveillance mechanism is online real time. Lot of controls are put. There are daily price limits. There are fixed open position limits at client and member level. Everything is very crystallized. Now, low impact cost. Now we see 0.01%. This is a very, very low impact cost. So the cost is low and your easy entry and easy exit. You don't get stuck up in the contract if you have to close your position. That's the important benefit of the larger number of participants and the larger liquidity and the volumes available. This is just a give you an overview how our trading screen looks like. So we have a multiple, you can view all the products, there are multiple parameters available. This is if you see the market watch, the 5 available. If you see now, you can see the fineness of the quotes. So fineness of the quotes again indicates it is just at one tick level. So there's such a kind of a fineness of the quotes is there. And these are the different order. We have all types of time-based and price-based orders which are available on our platform. These basics do's and don'ts. Yes, you need to choose your member broker, fulfill your KYC, and then update yourself specifically in the derivative markets. What is initial margins? What are the mark to margin requirements? You need to understand from your broker all these requirements. Then exchange rules and regulations, keep yourself updated with the exchange circulars coming into line, general do's and don'ts, the risk management mechanism, and then obviously you can negotiate for your brokerage fees, whatever you pay to the broker. Now, if exchange, besides the brokerage, exchange is charging you very minimal exchange transaction charges, which is around 1 lakh per turnover. Basis your turnover, if you have an up to average daily is on a monthly basis, it gets calculated. So if your average daily was up to rupees 350 crores, you are charged 260 rupees, 2.260 per crore or 2.6 per lakh. On incremental turnover, it is again 1.75. So since you are moving beyond 350 crores on average daily, your transaction fees, this is a very minor component. If you see 260 rupees per crore or 175 rupees per crore. So again, the basic do's and don'ts, be a responsible. The gist is be a responsible investor. Do not go by only these days, internet has exploded. Everywhere they have the tips, like it says every Indian is a doctor and every Indian has some of the tricks to tell you how to trade. So please do not go by it, take your own research, understand. There is a lot of data available on our exchange website. Understand from your brokers as well, and please be a responsible investor in the market. These are some of the links wherein these are the data available. There are a lot of, you can follow the MCX handles. There are a lot of YouTube videos we upload continuous basis. There's a lot of data on our website. We have a hedging documents available for each product also on our website, or you can reach me at any time. I can share my email ID. So any one of you would like to, you can reach me over there. So just wanted, thank you so much for your time. Thank you so much all. I just wanted to check in whether like today's participants who are there, most of them are based out of Jammu and Kashmir.
Yes, actually it is a joint seminar with ICA. So we have both. There's a mix of participants.
Mix of participants. Because really happy to, and the kind we are seeing a lot of development in JNK and a lot of opportunities for chartered accountants, definitely. So my email ID is ruchi.shukla@m6india.com. So you may, if any one of you would like to have specifically want further information or on specifically for some specifications for your clients, you can please get in touch at any time. Thank you so much. Happy to be part of the.
Sure, ma'am. Thank you so much.
So much, ma'am. Especially for this like me in this field. Thank you so much for appraising us with this field. Now I would like to hand over to our chairman Nakulji for further proceedings.
Thank you so much, ma'am. Now I request Priya to please carry over the proceedings.
I will, Nakul. Thank you.
Are there any questions? Do you want to take me any questions in case they are there?
I will take it up.
Ma'am, actually the question answer session is scheduled after the session of Gauri ma'am.
Okay, because I will have to shift it to the. I will be exiting right now because I am having a
Okay.
back-to-back some other regulatory meeting.
So
Sorry,
I think
Gauri,
you will
sorry
have
so
to
much. If
connect
I
to
can just
Vivat.
take 2 minutes if any of the questions are there, or you can write to me. I'll make sure that I'm happy to reply back all the queries to it.
No issues, ma'am. I think you can take the question.
No, I'm really sorry. I'm really sorry. Suddenly a regulatory meeting came up. No, next time on the day.
Oh, I think it was a very informative session. So I would be happy if you take the questions first. That's completely fine with me.
I'll just quickly take the questions. I'll not take much of the
Yes,
session
yes.
this time. There are just two questions. One is that what will be the impact of Russia-Ukraine war in commodities market in the future? As we've seen, the crude oil and edible oil prices takes charge. They really go up. So that's query of one of the members.
See, one thing is I am not allowed to forecast under my regulatory guidelines. I cannot forecast, but yes, it's a huge geopolitical event, and Russia, in fact, is the supplier of a lot of natural gas and the crude oil. So obviously, it is going to impact the supply in the market, and more sanctions being put onto Russia. Yes, the supply is disrupted. In fact, there's a huge disrupt to the European markets because they've set up the pipelines. The impact will be huge, but yes, ultimately, whatever the outcome, if the ceasefire happens, well and good. If the sanctions are lifted, all will have a daily impact. So we need to keep a track on this. But today we are seeing a fall, gradual fall we have seen in the crude oil prices, mainly because one is the Chinese demand, with a lot of cities going under lockdown, and there are hopes of ceasefire happening. So, but I can't predict whether the graph is going to go up or down. That's for the markets and the fundamental factors to decide.
This was the only question we had.
Okay.
On behalf of J&K branch of NIRC of ICI, thank you, Ruchi ma'am, for a
Thank you so much. Thank you so much. It is always, I'm very happy always to be part of my fraternity. Thank you so much. Thank you, everyone.
Thank you, Ruchi ma'am.
Thank you so much, Gauri, for giving me this time. Thank you.
Thank you, ma'am. Thank you.
Yeah, thank you.
I now would like to welcome CA Gauri Methi, and I would also like CA Saurabh Pragal to please introduce her for the second session.
Good evening, everyone. As we all know, the second session of our webinar will be taken by CA Gauri Methi. CA Gauri Methi is a qualified chartered accountant and has also done Masters in Financial Management from Vlerick Business School, Belgium. She has also been a key speaker in various CP events hosted by Jaipur branch of CIRC of ICI and many other platforms. Today, she will be deliberating on new age IPO norms for startups. So without any further delay, I request CA Gauri Methi ji to proceed with the webinar.
Thank you. Thank you for such a warm introduction. I would also like to thank Jammu and Kashmir branch chairman, CA Nakul Saraf ji, and other committee members for hosting this session and giving me an opportunity to present my ideas. So first of all, I'll start sharing the presentation. Yeah, okay. I hope it's visible. So to begin with the session, I would like to give a brief introduction. So today's topic is, my topic is new age IPO norms for startups. So to begin with, I would like to give a brief introduction about what is happening in the startup ecosystem in general. So nowadays, if we look at the number of startups that have been registered under Startup India portal, it's somewhere around 60,000. So 60,000 startups have been registered under Startup India portal till now. And I am not sure if any one of you has an idea that how many startups have been converted into unicorns. So it's like 44 startups have been converted into unicorns in the year 2022 itself. So it's a huge number out of the total number of startups that have been converted into unicorn, which is close to 90. So we are seeing a rapid growth in the startup ecosystem. And as a professional, we all shall gear up to be a part of this rapid growth. So and then the most important factor of this growth is the startups going into public. So we see a lot of startups recently which have gone into the public listing. In the year 2021 itself, there are like 8 startups which have gone into the public listing. So definitely, there is a lot of disruption that is happening in the startup ecosystem. SEBI is also making a lot of regulatory changes in the norms and regulations to promote the startups, to encourage them to go for public listing. So I'll just brief a little bit about the flow of the session and the areas that we will be discussing. So first of all, we will discuss about the Indian startup ecosystem. What are the pros and cons and success factor and challenges of going into the public? Then we will discuss about the push that the SEBI and other regulatory authorities are making for promoting or encouraging the startups to go for listing. Then we will discuss one of the case studies. What are the valuations and other techniques that the startups are using these days? Then there is a specific platform BSC has developed for startups to get themselves listed through that platform. Some of the upcoming startup IPOs we will discuss, and in the conclusion, what are the proposed IPO norms that have norms that are proposed in the SEBI consultation paper. So we'll start with the Indian startup ecosystem. As I was mentioning before about the startup, so there is a flagship initiative of the startup of the Government of India, Startup India. Under that initiative, 60,000 startups have been registered. So it has seen a growth of 15 times in the number of startups that have been registered since the last 2 decades. So this ecosystem is on a boom. The startups that are registered has increased, and ultimately these startups, once they are registered in the Startup India, then they get DPIIT recognition. Through that recognition only, they can avail the benefits that have been provided to a startup. For instance, the tax benefits, the ITR benefits, and whatever other benefits that are available under any government scheme, they are provided through the DPIIT recognition itself. Then it is also notable to see that India has emerged as the 3rd largest startup ecosystem in the world after US and China, with a market valuation of $300 billion. So in entirety, the boom in the startup ecosystem and how the country is responding to this startup ecosystem is really on a growth trajectory. So as I was discussing before, that 8 startups have gone for IPO in the year 2021. So there are so a few of them are Zomato, Freshworks, Nykaa. So Zomato was the first startup after. So basically SEBI, there were certain regulatory changes in SEBI which allowed loss-making companies to go for IPO. And Zomato was the first mover advantage in this after this regulatory change to go for listing. So it was the first company startup to go for listing after SEBI made the regulatory changes and allowed loss-making companies. So earlier what was happening was that SEBI did not allow any loss-making company to go for listing. That's why when Make My Trip, Yatra, and such other companies got themselves listed in NASDAQ. Now SEBI realized that there is a need for change in the regulations because they want to encourage these companies to get themselves listed in the Indian market only. So they are really promoting this ecosystem and allowing them to list. Then everyone has heard about Mensa, that how Mensa became a unicorn in less than 1 year. So they raised their first round of funding immediately 6 months after their incorporation and converted into unicorn in less than 1 year. So there is also a study which suggests that the companies that were incorporated before 2011 took an average of 10 years to become unicorn. This time has significantly reduced by around 50%. And now, after 2012, it takes on an average 5 years for a company to convert into unicorn. And we are hopeful that the same will happen in case of IPOs as well. So earlier the time taken was more, and this time is expected to reduce by around 50% by the year 2026. So this shift will be seen in the listing environment as well. Then Nykaa, we all have heard about Nykaa. So this was the first female-founded unicorn to go public, and we are hopeful with the kind of push that the government is giving to women entrepreneurs and providing them all the incubation and accelerators programs for promoting women entrepreneurship. We hope to see more such kind of startups to get listed, more such women entrepreneurs as well. Then Freshworks is the first Indian unicorn to go public in the US markets. So this is a brief about what is happening in the startup ecosystem and how government is taking, SEBI and other regulatory authorities are taking all the initiatives in pushing this startup ecosystem for listing in the Indian market. We will be discussing later on. Before going further, we will discuss about the pros and cons of going public. So one of the biggest advantage of going into public is to provide exit strategies to the existing investors. Now, this is a question that is still to be answered, whether these IPOs play as an exit strategy. They are only so the IPO boom is only to provide an exit strategy to the existing investors, or they are really helping in raising funds to the startups and providing them the required boost for their growth. So this question remains unanswered, and this is something we all need to think about. So the biggest advantage is indeed to provide exit strategies to the existing investors. Then undoubtedly, it helps the company to raise funds to meet their growth strategies and growth requirements. So sometimes when a VC or a private equity player invests in a company, it might be possible that they invest a limited amount because they do not believe in the idea of the company and their growth strategy. But when they go to the public, it can happen that the public is convinced with the growth and the idea of the company and the business strategy, and they're willing to invest more money. So the amount of money that can be invested can be really multifold, can increase multiple times in comparison to the VCs and PEs. Then it also results in a brand recognition and creating a brand awareness and recognition amongst the customers and all the public in general. So these are some of the biggest pros of going for listing. Then the biggest disadvantage is that it is a very time-consuming process. When a company goes for listing, they have to be very transparent and make all the disclosure requirements, and they have to disclose about every minutest details of the company. So this is the biggest disadvantage, that they have to be very transparent and they have to put a lot of time in the investor relations. Then it also has a huge cost associated. So whenever any company goes for IPO, there is a huge cost associated with it, which again they have to incur, and in the hope that it will result in profit later on once the people start investing in it. Then another one is that by going into public, it also leads to a dilution of the equity of the investors. So there is a lot of dilution that happens if more and more people are involved in this. Then there are also, we'll discuss a few success factors and challenges for listing. So one of the biggest success factor for any successful IPO is a strong management team. So management team plays a very important role. All the points that are mentioned below, all the 4 points, they cannot happen without a strong management team. So basically, when a company goes to public, the face of the company is the management team. So the management team has to sell the story of the company, has to convince the people about their growth and about the company's business pattern and strategy. And the management team are only responsible for deciding the price of the company, the timing of the IPO, and making the company IPO ready to meet all the capital requirements. Then now, if we look at the challenges, then the biggest challenge for before going into public is that the company, the startup, does not have strong internal controls in place. So the problem is that the founders and all the top management are involved on the business side of the company, and they do not pay attention to what is happening in the internal controls in making a robust internal controls. So they, in this wave, in this rising wave of companies going into listing, they also ride, the founders also ride on that wave, and they are more focused on going making the company list, but they do not understand that the internal controls have to be established before listing any company, because ultimately they will be answerable to the public later on, and all the reports and everything will be reflected through those internal controls. So they need to have a robust internal control, which they lack before going into public. And to make those efficient internal controls, again, they need a strong board of compositions, which again they need to recruit qualified non-executive board members, qualified audit committee. So the entire board and the committee members have to be strong and independent for making this decision. So these were in nutshell the challenges and success factors, pros and cons of going into an IPO. Now we will discuss how the Indian startup ecosystem is being pushed by SEBI. So as I was discussing it before also, there has been a trend that was witnessed by the SEBI, that the companies are going for listing in the foreign markets, just as I was mentioning about Make My Trip and Yatra. So why did they go for listing in foreign market? It's just because of one simple answer, that because SEBI did not allow listing of loss-making companies in the Indian market. So SEBI lately SEBI realized that they have to change these norms in order to promote and encourage listing in the listing of these companies in the Indian market. So for that, they created an institutional trading platform in 2015. So the idea of creation of these institutional platform was that they wanted that the startups shall be listed in this platform for raising money. But this platform did not really attract the startups and did not responded in the way SEBI planned to. So in June 2018, SEBI decided to review this framework and identify what are the areas for improvement. And finally, after a lot of discussions internally, in December 2018, they decided to ease those listing norms, and they created a innovators growth platform. So this was in the same line as the institutional trading platform. It was again created for listing of these startups on this platform. So this platform provided easy listing norms for startups, and they promoted startups which are into intensive use of technology, IT, intellectual property, data analytics. So the idea was ultimately to promote listing in the Indian market of loss-making startups as well. Then so in order to promote this, they made some regulatory changes in the ICDR regulations as well. So under Rule 6.2 of the ICDR regulations, SEBI allowed listing of loss-making companies in the domestic markets. Now we will further discuss in detail the changes that happened in the listing norms. So what were the changes that happened? So as I was mentioning before, that SEBI made some amendments in the ICDR regulations as well. So what were the changes that happened due to these amendments? So they allowed a listing of loss-making companies, but they limited the amount of shares. So basically, the loss-making companies can offer 75% of the net shares to QIBs, and the profit-making companies can offer 50% to the QIBs. And in the same way, a loss-making company can only offer 10% of the shares to the retail investors. However, a profit-making company can offer 35% of the shares to the retail investors. So by taking this move, SEBI really wants to protect the interest of the retail investors by limiting this percentage of shares from 35% to 10% in case of a loss-making company. Then SEBI also increased, so the lock-in period proposed for anchor investor has also increased from 30 days to 90 days in case of startups. So this is again a move in which SEBI wants to promote that the anchor investors should be invested in the company for a longer duration of time, so that it also increases the trust of people in the company, and they also the anchor investors also it results in arriving at correct valuations by the anchor investors before they invest. So the lock-in period has been increased. Then there's also one thing SEBI also understands that startups really move towards inorganic growth patterns, and they want to create disruption in the market. So understanding the strategy of the startups, SEBI allows startups to fund the money amount raised for inorganic growth, but they have to make those disclosures. Like disclosure for the end use of these raising these funds have to be made to the SEBI. For instance, if a company is raising say 100 crores of funding, so out of that 100 crores, 35% of that funding, that is 35 crores, can be invested towards inorganic growth patterns. And the disclosure has to be made for the remaining 75%. So out of that 35 crores, 8 crores can be invested in unidentified acquisition. Basically, 25% of this 35 crores can be invested in without any disclosures, and the remaining amount has to be disclosed. So, for example, if a startup plans for inorganic growth and they plans for acquisition of target companies, then the company has to disclose which all target companies they aim to acquire, what is the size of the target company, what is the deal size for that acquisition. So these disclosures have to be made to SEBI. Then this is how they are promoting startups for inorganic growth. Then there are also some relaxation norms which are provided to startups. Like earlier, the early stage investors were required to hold their pre-issue capital for 2 years, which has now reduced to 1 year. So this is a relaxation norm which is provided maybe to provide early exit to the investors, angel investors and other investors. Then discretionary allotments of up to 60% of the issue price to an eligible investor. Now there can be an instance where there is oversubscription by the QIBs in a startup. So in this case, SEBI allows startup to allocate the shares up to 60% of the issue size as per their discretion itself. So these are the list of a few changes that have been made in IPO norms, relaxations that have been provided to startups to list in order to boost them and encourage them for listing in the domestic markets. So we will also discuss in brief about the IPO life cycle. So how a company gears up for the IPO and what are the different steps that are followed. So as we were discussing previously, that the biggest challenge in case of IPO is that there are weak internal control systems. So before going into public, the company really needs to focus on defining its internal control system and having a robust system in place. So for defining that strong internal control system, they need a strong management team, which we were discussing before also, that is the important success factor for any successful IPO. So the human capital, they really need to invest in the human capital for taking all the important decisions before an IPO. Then a company also needs to analyze what will be the tax liabilities, or certain those tax liabilities in advance. For example, in case of a startup, there is an angel tax implication. So they need to understand those tax implications as well. Then corporate governance. So whenever a company goes for IPO, those charged with governance and other key management persons are responsible to are answerable to the public. So they have to make sure that they follow all the ethical practices in the company, because everything would be answerable to the public. Investor relations. Now, again, before going for listing, a company has to be prepared for being transparent, because after listing, they have to disclose all the whatever is happening in the company, all the transactions, all the disclosures have to be made to the public. So they have to be very transparent and have to prepare audited financial statements, the director's responsibility statements, and other such statements. So the investor, in order to build that investor relations. And finally, once the company has gone through these cycles, then finally they can file the required draft earning prospectus and financial and SEC reporting requirements, and whatever other reporting requirements to SEBI for listing. Then there are certain common accounting and reporting issues before going to public. So as we were discussing, that a company has to be IPO ready before going for listing. So these are certain changes in their practices that they have to follow before going to public. Now we will discuss about segmental reporting. So the company needs to identify, any startup needs to identify that what are the different segments. Like they have to divide their books of accounts, the financials, into different segments based on the type of products they're offering, type of services, or based on the geography. So they have to classify those segments and prepare the financial reports according to those segments, because immediately after going to public, segmental reporting has to be prepared. It is a mandatory disclosure. So before going into public, and in order to be IPO ready, segments have to be identified and the reporting has to be done by any startup in this format only. Then implementation of NDS. NDS is mandatory for all the listed companies. So this transition to NDS also takes a lot of time. So the companies need to implement the NDS, start recognizing all the revenues and incomes in as per the NDS only, in order to make their books of accounts strong. Then ERP implementation. So undoubtedly, automation of the books of accounts and automation of the entire system is really important before going for any listing, because the traditional accounting platforms that are being used have to be replaced. A company needs to select a more robust accounting platform like SAP, Microsoft Dynamics. Like as per their obviously as per their budgets and as per the management decisions, they have to select a better accounting platform in order to have a more control over what is happening in the country, and in order to have proper disclosures and preparation of better reports, like in order to reflect what is happening, in order to be aware about what is happening in the company. This ERP selection of the ERP and implementation of the same has to be done before going for public listing. Then stock-based compensation. So there might be cases where the valuers or the credit rating agencies are paid in the form of stocks only, in order to retain their interest. So again, these are the decisions that have to be made. Then EPS disclosures. What are the compensations that are being done for the higher management? What are the salaries and other expenses that are being paid to them? So all these disclosures have to be made. So in nutshell, any startup has to follow a practice of all the disclosure requirements, preparing their audited financials up to the mark as per the listed company. So they have to follow this practice of preparing and getting their company up for IPO. Then consolidated financial statements have also to be prepared. Even if any one company goes for IPO, then all the subsidiary companies have to be consolidated and have to be reported as one entity only after going for listing. This is also important because this is the place where a chartered accountant plays a very significant role. So it's important that because they for any company to get up for an IPO, they need an expert finance professional and they need an expert's opinion. So this is how a chartered accountant can help assist the company in gearing up and preparing them for any before going for any listing. So now we will also discuss in brief about Zomato. So as I was mentioning in the introduction, that Zomato was the first company to go for IPO after SEBI relaxed certain norms in listing and allowed loss-making companies to go for listing. So SEBI was Zomato was took the first mover advantage in this case. Now, Zomato is a company which was incorporated in the year 2008. There were two founders in the company at that time. Then Zomato raised its first round of funding, seed funding, in the year 2010. And after raising that seed funding round, its valuation reached to somewhere around 14 crores. Then they raised series funding and different rounds of series funding. For instance, in 2013, Sequoia invested in Zomato in Series D funding, and their valuation reached to around 1,000 crores, and so on. Different funding. There were different funding rounds, and finally, Zomato became a unicorn after 8 years. In 2015, it became a unicorn. It was a big milestone for Zomato. Then there were another rounds of funding. And finally, in the year 2021, Zomato went to public listing. Now, here we can also see that the valuations are also increasing disruptively. So, if in the year 2010 the valuation was around 14 crores, then in the year 2021 the valuation reached to 40,000 crores. So, which is a significant increase in the valuation of the company. So, this. Then there are also now if after so when Zomato went for listing, the shares were priced. The listing price of the share was somewhere around 116, and the current share price is somewhere around 76. So we see that there is a correction in the share price as well after listing. Then there is also one interesting factor. In this case, so when Zomato went for listing, the promoters' shareholding was somewhere around 5%. But recently, we see that the promoters' shareholding has reduced to negligible. So there is a shift in the shareholding of the company. So promoters are involved operationally in the company, but they do not have any financial interest in the company. So this is an interesting fact. Now again, the answer to the question, like the question remains unanswered: is IPO providing an exit strategy, or is it really a growth strategy? Because even the promoters, the founders, the core team members do not have any financial interest in the company. The company is working on its own. So this is something which remains unanswered in case of Zomato as well. Now, as we looked at Zomato's case study, we saw that the valuations increased significantly from 14 crores to 40,000 crores. So here is one interesting thing, that earlier the valuation methods that were used were mainly driven by the income and the profits that the companies were earning in the previous year, and they were then estimated at some assumptions, considering some assumptions, and finally the valuations were arrived at. But with the increase of internet-based companies and with the increase of this technology and the startup boost in the startup ecosystem, we see that the factors which are used for valuation has also completely changed. Now the valuations will be more driven by the number of downloads in the app, the number of clicks, number of users who are viewing. So the valuation game has completely changed in case of the startup ecosystem as well. And again, I personally feel that we as chartered accountants really need to understand how the valuations are arrived at and need to gear ourselves up for arriving at these valuations, because the traditional approach cannot be used for valuing these startups. Then there is also, I also found one ICI ATQ on startup valuation, which also signifies and listed down certain factors that shall be considered for valuations, like the number of visitors per month, customer conversion rate, monthly recurring incomes, churn rate, burn rate. So again, these are the terms, burn rate, churn rate, which we never heard about earlier and which were never used for arriving at any valuations. But now with the change in the ecosystem, with the startups coming in place, the valuations has also changed and the assumptions have completely changed for valuing any startup. But in that ICI ATQ also, the preferred method for valuation is still discounted cash flow method. So the assumptions might change, but the method is still the conventional discounted cash flow method only for arriving at these valuations. Now, after talking about all the valuations and how a chartered accountant really need to gear themselves in this entire ecosystem and be a part of it, I would also like to talk about how BSC took an initiative for promoting startups. So BSC created its own platform for listing of startups and SMEs. So initially it created a platform for listing of SMEs in 2012, and later on in 2020 it also added startups to that platform. So it provides a platform where startups can list themselves and raise funding from the public, and like small amounts of funding they can raise. And later on, if BSC feels or if not feels, but if the obviously if the growth and the listing requirements and every other compliances are made, then it is also mitigated to the main board. So till now there are like 12 startups that have been listed on this platform. The first one was Alpha Logic Techgesis, a Pune-based company, was the first startup to get itself listed on the BSC startup platform. So till September 2021, 10 companies were listed on BSC platform, and they raised close to 34 crores from the market. So the amount is not it's not a huge amount. So it's mainly for raising those small amounts of money from the market. There is also an eligibility criteria for the startups which can be listed in the BSC startup ecosystem. It shall be a registered entity which is operational for a minimum period of 2 years and has a positive net worth. A similar initiative was also taken by NSC, in which it launched an Emerge ITP. Again, it was a similar platform for listing of startups and providing them a boost. So now here we will talk about some of the upcoming Indian startup IPOs. So here are a list of a few startups that are in the list of being listed. Delivery, Ixico, Oyo. So now after looking at the story of Zomato or Paytm, for instance, so the same happened in case of Paytm as well. Paytm got itself listed at around 1900, while the floor price was somewhere around 2100. So it was listed at a discounted price, and now the share price is 600, somewhere around 600. So there has been a significant decrease in the share price. It decreased by more than 70% in a period of 3-4 months. So now SEBI is really worried also at the same time. So they have relaxed certain norms and provided relaxation in an easy listing of these startups. But they are concerned that in relaxing these norms have also some adversities. So that is why they have hold it. So, for example, Oyo, the listing of Oyo has been going through a long time, but they are really reviewing these prospectus and all the IPO listing documents in detail before making sure that a company goes for a listing. They really want to examine it in detail, and it's been pending for more than 5 months. So in nutshell, so SEBI has relaxed norms, but SEBI also is doing a lot of brainstorming and brainstorming on how they can change these norms and what shall be proposed to find out a balanced approach for listing of these startups. Because there are, as we are discussing, that in case of Zomato, in case of Paytm or other startups, what is happening is that it appears initially that it's more like providing an exit strategy to the investors and the founders and putting public in risk. So SEBI wants to be assured that wants to assure the interest of public in general and safeguard their interests. That is why they are proposing certain norms in their SEBI consultation paper and doing a lot of brainstorming on that consultation paper and in proposing these guidelines. So, for instance, credit rating agencies, SEBI proposes that the credit rating agencies shall be done through SEBI monitored agencies only. And the payment to those rating agencies shall also be driven through Investor Protection Fund. So this is an initiative to ensure that there is no conflict of interest while arriving at any of the ratings of any of the startups before going for listing. Then it also emphasizes that as we were discussing, that valuation plays a key role at every step of any startup. So whenever any startup goes for any round of funding, valuation is a mandatory document. They have to get themselves valued, and before IPO, this valuation holds a very significant importance because they help in arriving in the value of the company. So a issuer company, SEBI wants that the issuer company shall disclose all the KPIs that have been considered while arriving at these valuations in the past 3 years, and what are the KPIs, what are their justifications, or justifiable reason has to be provided for selecting those KPIs as well. And those KPIs shall be certified by statutory auditors. So this is an initiative that SEBI is taking to make sure that the correct valuations have been arrived at. And in order to make sure that the interest of the valuation companies and the other persons who are involved in arriving at those valuations of pre-IPO formalities are not vested, they want that they propose that these companies and the employees shall be paid in shares with a lock-in period of 6 months or 1 year, so that their interests are still vested in the company, and their interest is in providing the correct valuation amount and not just inflating the valuations of the company and ultimately putting the retail investors in high risk. So they really want to be, SEBI wants that to be assured that the valuations arrived at are correct, because valuation plays a significant role in ultimately driving this entire ecosystem. So it has to be correct to the extent possible. Then there is also, in SEBI also wants that in the draft prospectus, whatever transactions have happened in the secondary and the primary market in the past 18 months, whenever there is a dilution of any stake of more than 5%, then IPO bound companies shall be mandated to report those disclosures. The price at which the shares are sold shall be disclosed, just so that there can be a comparison of what is the listing price and what is the floor price that have been arrived at, and what is the price that they have they have to benchmark basically the price of listing. So this is in nutshell my view on the entire topic about how the new age IPO norms, how the IPO norms have been changed, how they are still going back and forth. Even the SEBI is doing a lot of brainstorming on defining these IPO norms. What shall be the correct IPO norms for listing? So they want to promote startups for getting them listed in the Indian market, but at the same time they want to be rest assured that in promoting and relaxation of those IPO norms, the retail investors and the general public is not put at risk. So there's a lot of brainstorming that I believe we also need to do about this topic. What are the changes that are happening in this ecosystem? How we as chartered accountants and professionals can be a part of this ecosystem and assist the startup in ultimately going to those listing rounds, raising funding, and in whichever way possible. So I'm really again thankful to the Jammu and Kashmir branch, and I'm also thankful for the Committee on Financial Market and Investors Protection for organizing and hosting this event, and for giving me an opportunity to present my ideas on this topic. And I would be glad to get any such opportunity in future and be a part of these of such sessions. So thank you very much. Thank you.
Thank you, CA Gauri Mehti, for a great session today. There is one question that a member has asked. CA Jayesh Chauhan has asked, what is inorganic growth? Could you please answer that?
So organic growth is something that we see in every company basically. So whenever a company has been established for 5 years, say they are growing, their revenues are growing at a bare minimum 10-15%. So that is organic growth. It's been a slow growth. Like it's organic. It's a slow growth that is happening in the company. But inorganic growth is, for example, if today, if in the next year my revenue has increased by say 70%, so that is inorganic growth, like creating that disruption in the market by maybe acquisitions, by maybe acquiring the target companies. But I'll just give you an example here. So Pharmacy was a startup which acquired a traditional company, Thyrocare, it's a healthcare business. So this is a part of inorganic strategy.
Sorry to interrupt. There's a lot of disturbance. Can you please come again?
Hello? Yeah.
Yes, please come again. Because please mute yourself.
I think someone has to mute it because someone
mute yourself. Please carry on, Gauri. Sorry for the interruption.
I was giving you an example of a part of there's events. Hello? Yeah.
It's done.
So I was giving an example of inorganic growth. So there is a startup Pharmacy which acquired a traditional company, Thyrocare. So Thyrocare was a well-established traditional company in this healthcare business, but Pharmacy acquired 60% stake in that company. So this strategy is an inorganic growth. This is not something that a traditional company does. So this is an inorganic growth to be to make disruptions in the market basically, and ultimately reach high revenue levels. So this is what is inorganic growth basically, unjustified to the public maybe, but it ultimately leads to increase in
we can say a fox-like strategy.
Yeah.
There's another question from C.A. Ratnakar who's asking, looking at the Zomato IPO, to protect the interest of retail investors, lock-in period should be increased for the promoters. He's just giving in an input.
The lock-in period shall be increased for the promoters. That's agreed, I think. I also believe in this. There's a lock-in period for promoters shall be increased. Until now, I did not find any such SEBI regulations for which has proposed this increase in lock-in period, but I completely agree with the point.
C.A. Subramaniam Iyer asks from Kochi, who is responsible for the high valuation in Zomato?
I mean, I obviously I don't know this who is responsible, But the idea of presenting about the valuation was that the valuation game is changing. So the valuation is increasing at a very significant level. So that's where I also feel that we as chartered accountants and professionals should really pitch in and understand that how these valuations are arrived at and at the ground level, and how we can guide these valuations. So, and I also believe that the institute should issue a valuation standard which defines that how the valuation shall be conducted in case of a startup. So specifically, a valuation standard shall be designed by the institute itself to enlighten all of us for the same.
All right. These are the only questions we have for the time being. So thank you for the wonderful session, Gauri ma'am. I now request the Vice Chairman of J&K branch of NIRC of ICAI to please present a vote of thanks. CA Vikas Pradhani.
Good evening to all. I'm excited to be the part of this webinar and thrilled in presenting the vote of thanks on behalf of J&K branch of NIRC of ICAI. At the outset, I would like to present the first thank you note to the Chairman of Committee on Financial Markets and Investor Protection, Shri CA Ajay Goyalji, for conducting this webinar and training programs for members at large. Further, thank you to each and every member of who is a part of this committee. Now, the second thank you note is to the lovely speakers of the webinar, Ms. CA Ruchi Shukla and Ms. CA Gauri Mehti. I thank you both for taking out time from your busy schedule and sharing your knowledge with members at large. Ma'am, your deliberations were thought-provoking and fantabulous. The topic were quite unique and complex, but you make it look like a cakewalk. And lastly, a big and cheerful thank you to all the participants for their presence and patience. Thank you all. Hi, Priya.
With this, I believe we can end the session.
Thank you.
Thank you.
Thank you so much, ma'am.
Thank you. Yeah.
All
I
right.
would also like to thank CA Anuj Goyal sir and also Griever ji and Amit Agarwal for giving me this opportunity. So thank you so much. Thank you.
All right. Bye-bye. Good day.